Right, I'll push us on to Prologis. So Prologis reported this week, and there again, it's a longer report, but I've just pulled out the most sort of pertinent stuff for us. So Prologis, for those that don't know, it's a REIT in America. It's a warehouse focused real estate investment trust. It was the biggest REIT around, although I'm not entirely sure if that's true with all the data center growth that we've had recently. Maybe Steve could check that while I'm quickly waffling. Shares were up about 9.37% on the week. It's up to just over $118. And here's why. So they said that funds from operations, this is core funds from operations, would be about $1.50 per share. Analysts only wanted $1.39, according to LSEG. So it's quite a hefty beat. It's the old Greg's analogy that Steve and I give, where it only sounds like 11 cents, but it's actually a fair leap to go from expecting 139 to get to 150. It's decent, really decent beat. Especially for a REIT, obviously, which can't go around and saying, does anybody fancy paying a little bit more? So Moghadam, who's the CEO, Hamid Moghadam, said post-election leasing activity has been strong. Our ongoing conversation with customers support our expectation that the market is nearing an inflection point. And what he's referring to here is essentially just during COVID and just after COVID, there was a big oversupply of people looking for warehousing at a rapid rate. That was a lot of growth pulled forward for Prologis, who then went out and made some pretty big acquisitions of even more warehousing to try and keep up with demand. And then all of a sudden, people said, actually, we probably don't need all this space, or we're a bit over space. So we're just going to pause our expansion plans while we, sweat the assets a little bit. And they've also had a slowdown in logistics as well, which has affected them. Moghadam thinks we're getting through the end of that. In terms of guidance, they said core FFO for next year will be 565 to 581. The midpoint of which, however, is a little bit below what LSEG said the analysts want of 577. But the market didn't care, Steve. Sent it up about 13.37 year to date. 2024 was a bad year for it, though, down 20.7%. I'm working that out as being about 29 times earnings. If you wanted to go for earnings for your REIT, I wouldn't bother. But I don't think it's too bad of a price around here, Steve. About $118. One that you like the look of?
If I were ever interested, I'd be starting to be interested now. I think I'm just looking up US REITs at the moment and trying to sort them by market cap. The second biggest here is Equinix by market cap. Then it's American Tower. At the top is Prologis by actually a decent amount. It's 112 billion worth of market cap compared to 90-ish for Equinix and 87 for American Tower, which is, they could start getting closer to them, I guess, but still fairly well ahead. It's tricky to try and get a decent dividend yield out of this sort of thing, and it's an unusual kind of REIT where you look for growth. But Prologis it's more than just a business that happens to be in the right place at the right time, because, as you say, demand for warehouse space and industrial distribution and so on has been pretty strong lately, and it's been hard to do badly in that sector, especially in the US. But in fairness to them, they have done kind of more and better than most of the others. There are some good other operators here as well. You've mentioned Rexford to me before. I've mentioned Torreno to you. But this looks like a strong result. And Prologis is a stock that I always kind of feel grumpy about, because it makes me grumpy that people who don't know much about what they're talking about also like it. This is true of other things that I like and own, and I end up selling them because I feel cross about the company that I'm in. But it is a good business and might well be worth it's definitely worth keeping on the radar. Question is whether it's down enough to be better than the next best thing available.
Yes, my average on this one is around $100, so that's where I think that's a really good price for Prologis. So essentially another 18% off where it was. It's been there a few times though, but I think 100 and under for me is my sweet spot for Prologis, and it's where I'm. I would buy more if it was down there again. The only issue I've kind of got with it is that you would expect that I would be a bit further up than I was. I should be, 18% up at 118. I'm actually only about 5% up, and because the FX on it has absolutely killed me. I've held this one for a long time, And the pound to dollar has been murdering me for the last couple of years. So we'll see how that goes. And I think it's definitely on my list of things to. Actually, it's a little bit below the weight that I want it to be at as well. It's at about 3.5%, and I've always wanted my REITs to be around 4%. So it's on the list of things to add to. But like you say with Rexford as well, that's also quite high up in my list of things that I really like the look of. So lots to think about on the REIT front. I don't want too many of them, but some of them are still quite attractively priced at the moment.
Yeah, I feel the same way about REITs in general, actually. I don't want too many of them, but there are some that are quite attractive, and some where I sort of think, well, that's kind of similar to something I own at the moment in nearly every way, over in the UK side. But I also sort of think, well, what would be the kind of harm of it's not really diversifying if you basically just buy a matching REIT. I mean, it's still covered by a lot of the same kind of risks that you might have seen before. But you do knock off at least some company specific risks. Like the big issue with REITs a lot of the time is debt, and they have to be at least smart in how they manage that. And they can generally, any decent REIT operator ought to be able to manage their debt, assuming nothing wild happens on interest rates in either direction. It's big moves. They can handle kind of moves. They can handle rising moves for quite a long time. But what they don't go well is if things go surprise and upwards, or rates start climbing quickly. Is the big issue there, and you wouldn't get much of a benefit from having more than one REIT in the same sort of area exposed to that kind of risk. But I'm also kind of constantly thinking about REITs at the moment and wondering whether I should add another one. In fact, one I haven't talked about on this show yet to mine, but we'll come to that another day. Mostly because I feel like I can't. It feels like the most boring thing in the world to do, but sometimes that's the right thing, Steve.
Yeah, I agree with you there, Steve. Sometimes it's nice to have those sort of like anchors in your portfolio. The only problem with them sometimes is those anchors drag on returns rather than sort of providing you with the ballast that you hope they did.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.